Search is dead. Google's dominance is over. If earnings don't go up, how can the future possibly be bullish for Google? I mean, it's over. Google must resign itself to be a technology backwater, like Apple before it and Microsoft before that. Remember when Microsoft was pronounced dead in the late 2000s? Who cares that Google search prints $50 billion a quarter? ChatGPT is dominating now with an estimated 996 million in a quarter. Did you know they have 400 million active users? That crushes Google's paltry 1.5 billion active users. The cloud over Google is here to stay. The Wall Street types all say this, and I'm convinced, because they said multiple expansion is the only way Google rises over time. It's a fancy term, so it must be true. Welcome to The Quality Investor. This tweet made me laugh after I saw Google's earnings. No data, no acknowledgement of the conglomerate that Google, really Alphabet, has become. No foresight about how a $1 trillion business has the resources to adapt and thrive in this environment. Just typical short-sighted Wall Street bullshit. Google's call just wrapped up. Stock started the call up 3.5%, finished the call up 4.5%. Stock up because the results and guidance were ahead of whispers that search was going to be a miss. The long term. To stay bullish on Google, you either have to believe earnings are going up or the multiple will expand. Realistically, neither looks likely right now. The ChatGPT overhang isn't going away, and there's nothing Google can say to change that in the short term. Yes, the stock looks cheap, but it's cheap for a reason. We've been saying for 2 years, they have all the pieces, the data, the cash, the infrastructure. But here we are 2 years later, and the story hasn't changed. At some point, you have to ask, what's going to be different now? Meanwhile, competitors like Llama, Grok, and OpenAI have all improved fast. The bull case now depends on convincing yourself that despite everything we've seen, Google is suddenly going to flip a switch and figure out how to solve for a world beyond 10 blue links. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. It's all so tiresome. ChatGPT was released in Q4 of 2022. At that time, Google Services operating margin, search isn't specifically broken out in the earnings, was at 31.1%. This quarter, Q1 of 2025, Google Services operating margin sits at 42.3%, an increase of 1,120 basis points. Margin expansion, a key driver of value creation. If margins are expanding, top-line revenue growth can afford to grow at a slower pace. And to be clear, search revenue growth has slowed, but margin expansion is more important. That's why I harp on it in so many of my videos. But wait, I mentioned that Google has become a conglomerate. Alphabet now has many businesses providing streams of revenue. There is subscriptions, platforms, and devices. There is network. But there are 2 lines of business that will truly power the value engine for Alphabet in the future. That is YouTube and Google Cloud. YouTube is the largest streaming platform in the world, larger than even Netflix. Now, Netflix has higher revenue than YouTube ads. However, if you account for YouTube TV and NFL Sunday Ticket subscriptions, YouTube's total revenue for Q1 2025 is estimated in the $11 to $12 billion range. Compare that with Netflix's Q1 revenue of $10.54 billion. Secondly, and more importantly, YouTube has an estimated operating margin in the 30 to 35% range. Netflix is no slouch here, but its Q1 operating margin was 31.7%. So if you take the midpoint for YouTube, that's at 32.5%. If you believe the estimates, it is possible YouTube is even more valuable than Netflix, who has a $468.8 billion market cap. And viewership supports this. Here are some charts that compare streaming services. This chart here shows the total viewers for each of the streaming platforms. 2025 trend, streamers and YouTube will take pages from each other's playbooks. CTV is connected television, and YouTube has 171 millions of monthly users, a little bit less than Netflix. But when you factor in everything else with YouTube, it has an additional 77.6 million monthly users, and it blows away its competition, 248.6 million monthly users. And smartly, the article attributes YouTube's popularity is largely due to its wide library of creator and influencer content, and the ability for viewers to engage socially with those videos. YouTube becomes first streaming platform to break 10% of total TV viewing. So not only is YouTube dominating the other streaming services, they're starting to really catch up to normal television. Streaming as a whole is now capturing most of the viewership. We have 41.4% streaming services, according to Nielsen's total TV and streaming snapshot. You can see cable makes up now just a quarter of everything. Broadcast is 1/5 and other is 11.6. But within the streamers, YouTube captures 10.4% of that viewership, more than all the other streamers. YouTube is an incredibly valuable component to Google's future growth story. And like I said, if we believe these estimates, it's at least as valuable as a standalone property as Netflix itself. And I can't see why it's going to stop growing. As an incredible economic moat with its network effect, generates subscription revenue, and it's becoming the most influential platform in terms of creator content. All of that is going to turn into more viewers, which means more ads and more subscriptions and more money to the bottom line. Google Cloud is a fast-growing, highly scalable business. Its margins are expanding rapidly, 17.8% this quarter compared to 9.4% a year ago. This is high operating leverage in action. As it continues to scale, this margin will only improve. Google Cloud is projected to have a $120 billion run rate in 5 years. That alone could push it past a $1 trillion valuation. Twice that if it reaches Amazon's web services type margins of 37%. Alphabet as a whole is so much more than search. While search still has the largest revenue component at 56%, back in 2019, it was at 60.6%. This decline in search share of revenue demonstrates the high growth areas of Alphabet's other businesses. In short, a conglomerate. I haven't even touched on another potential growth area, and that is Waymo. Waymo is already doing 250,000 rides per week. For comparison, Tesla's robotaxi does 0 rides per week. My valuation isn't even accounting for Waymo. A while back, the DOJ announced that it was seeking to force Google to divest its search business from the rest of Alphabet. In the comments of the video I did for that, I was asked which is preferable, search or the rest of Alphabet. If this actually happened, I don't think it will, I said I would rather hold on to Alphabet sans search. YouTube, Google Cloud, and now Waymo provide massive upside in my view. This is why I sarcastically referenced that tweet early in the video. Wall Street types are so hyper-focused on search. They completely ignore the rest of Alphabet's businesses. They keep proclaiming the death of search. They keep focusing on earnings, which are important, but they are such a small component of value creation. Margin expansion, free cash flow growth, and high ROIC are all vastly better value creators than earnings. Wall Street is short-term focused and driven by noise. Investing in quality means focusing on those aforementioned value creators. So let's dive into this earnings report and find out if this high quality business is still a screaming buy based on my entry share price. Google did not perform post earnings like I expected that they would. I thought they'd have a larger jump than what they did. They are up almost 9% in the last 5 days. You can see the nice little post earnings jump, but they pretty much gave it back on Friday, closing the week at $161.96. I think it's unclear why Google gave some of this back. There are different opinions out there. The CEO citing short-term tariff headwinds. They declined to give a specific guidance for Q2. Maybe people are still hung up on the whole CapEx issue. But either way, they gave it back. Honestly, I don't understand how anyone looks at these earnings and believes Google is slowing down in some way. As a whole, revenues are up 12%. Search at $50.7 billion in just a single quarter was up 10%. YouTube ads was up 10%. Now, admittedly, I was expecting more like 12% growth on YouTube ads, but we still have 3 quarters left in the year. Google Cloud, the real pride and joy of Google's future growth strategy, up 28%. They're still demonstrating very strong growth here. And even subscriptions, a slower growing line of business for Google, was up 19%. But while they're still growing those top line numbers, to me, what's even more impressive is the margin expansion. Google Services, $32.68 billion in operating income. That gave them a margin of 42.3%. That expanded from 39.6% a year ago. And Google Cloud, $2.177 billion operating income with a 17.8% margin, up from 9.4% a year ago. And of course, the total margin for Google now sits at 33.9%, up from 31.6%. Google is doing exactly what you want to see in any business where investors expect growth. They're growing their top line, they're growing the bottom line, and they're expanding their margins. And here's another interesting aspect. Look at total TAC, or traffic acquisition cost. It's sort of a cost of goods sold for Google search. $13.7 billion, up from $12.9 billion a year ago. But here's the rub. That margin is now at 15.2%. This is the cost margin. So we want to see that a lower margin on that cost side. 15.2% margin, down from 16.1% a year ago. Now, to me, this isn't an outstanding, blown away earnings report. To me, this is Google just doing what Google does. Growing the revenues 10+% yet again and expanding their margin yet again. But what was most impressive for me was the free cash flow. They ended up having $36.1 billion in operating cash in this quarter, up from $28.8 billion a year ago. Google is expected to spend $75 billion in CapEx in 2025. That's an average of $18.75 billion a quarter. This quarter, they had $17.2 billion in CapEx spend. So we should expect to see that CapEx spend to be a little bit higher in the future quarters. But what's impressive to me is that their free cash flow came in at $18.9 billion, up from $16.8 billion a year ago. They also increased their free cash flow margin, albeit by a small amount, from 20.9% to 21%, but still an increase. One downside is Google did raise their dividend less than I was hoping. I was hoping for at least a 10% increase. It came in at a 5% increase. Their dividend for the forward 12 months will be at about 84 cents a share compared to 80 cents last year. But I'm still astounded that some people are miffed at Google's earnings, or they're somehow not growing the way they should be growing, or they're getting crushed by these search alternatives in some way. This ex-poster here, William Sasso, says, "Wake me up when ChatGPT prints $50 billion per quarter." Google Cloud continues to demonstrate remarkable operating leverage. And you can see this incredible growth for GCP since December of 2019. Every single quarter here, they're becoming more and more profitable and growing that top line faster, meaning margin expansion or operating leverage. I guess this is more proof that AI is going to kill them, as we see the trailing 12 Google search revenue numbers here just continually rising every single quarter. One post that caught my attention, however, was from Rose Celine Investments. And she says, "I'm getting a little annoyed by the misunderstanding around Google earnings. A few years ago, accounting rules changed. Now companies must report unrealized gains and losses from investments in their quarterly results." That's a good point here, and this is actually one point Warren Buffett makes continually because it distorts their earnings since he has a massive stock portfolio. That's critical here. Google owns a sizable stake in SpaceX, and when SpaceX's valuation spiked, it created a one-time $8 billion paper gain that inflated Google's bottom line by approximately 25%. That made it look like Google's earnings surged by 40%. Strip that out, actual earnings only grew about 7%. Yes, search and YouTube are still growing,
But the slowdown versus recent quarters is clear. Google Cloud is expanding fast, but ironically, even that came in below expectations, albeit only slightly. This isn't the first time we've seen this distortion. Berkshire Hathaway is a perfect example. Its reported earnings now swing wildly quarter to quarter solely because of unrealized gains or losses in its investment portfolio. Even Buffett has said those numbers are no longer a meaningful measure of performance. Moral of the story, if you're just reading the headlines, you're missing the real story. Do the work, understand what you own. And that's true. And that's why I said that earlier that earnings isn't the whole story here, isn't the most important thing to look at for value creation. You have to look at how the operating margins are doing, how the free cash flow growth is doing. Earnings can be distorted because of accounting tricks, accounting manipulation. That's why I didn't even mention what Google's earnings per share was. I want to show how I believe each segment of the business is going to grow over the next 10 years in my projections to give you an idea of how I'm arriving at my final valuation. And I think that's important because each of these businesses are different in meaningful ways. And we have to understand what parts are slowing versus what parts are growing faster. Now, it is true that Google search is slowing down its growth. So I'm projecting on my base case about 8% growth over the next 10 years for Google search. YouTube ads I have growing a little bit faster at 8%. Google network at 1.59%. And then Google subs, platforms, and devices at 6.87%. But the fastest growing part of the business is actually cloud. That I have growing at 14.7%. Most of that growth is coming in the first 5 years here. I have 27.5% this year, 22.5% in 2026, then 20%, 17.5%, 15% to 12.5% by 2030. And then finally, other bets, which is the tiny part of the business at 3.7%, and hedging gains losses at 0%. It's immaterial to the rest of the business. But that means I have Google growing at 8.5% revenue over the next 10 years. Keep that in mind, 8.5% compound annual growth in revenue over the next 10 years. If we look at the 5-year CAGR for each of these revenue segments historically, you can see Google search was at 15%, YouTube ads 19%, Google Cloud 37%, and the total revenue for business is at 16.7% 5-year historical CAGR. So I have my base case growing about half of that for Google. So I'm accounting for a revenue slowdown here. And even on the bull case, I have it at 11% revenue growth. It's entirely possible Google blows these numbers out of the water. This is one of the best run businesses in the entire world. They're very good at making smart capital allocation decisions. I'm being extremely conservative in my growth projections. And on that point, I have the operating margin expanding to 40% on my base case, largely driven by operating margin expansion in Google Cloud. On the bull case at 42.5%. So ultimately for free cash flow, I have free cash flow growth coming in at 12.3% on my base case and at 16% on my bull case. Free cash flow growth over the last 10 years is 19.7% CAGR. Over the last 5 years, 18.6% CAGR. So again, I'm projecting less free cash flow growth over the next 10 years than what we've seen the last 5 to 10 years. Conservative estimates. That margin for free cash flow, I'm expecting to be almost 30% on my base case and 32% on my bull case by year 10. So Google closed Friday out at $161.96 with a PE ratio of 18.1, far below their 5 and 10 year average. A forward PE based on my earnings of 18, which is also below their 5 and 10 year average. My DCF on the bear case comes in at $197.86, $260.67 on the base case, and $347.33 on the bull case. The dividend discount, it came down a little bit. I had to lower my projections on dividend growth due to the fact they only raised their dividend by 5%. So on the bear case, I have it at $117.15. On the base, $171.68 and $266.92 on the bull. The exit multiple comparison is at $289.91. I'm using comps of Microsoft, Netflix, Apple, Amazon, and Meta. So with no margin of safety, my buy price for Google, $251.26. With a 20% margin of safety, my buy price is at $201.01. And that's exactly where my buy price was last earnings. I didn't raise it because, like I said, this wasn't a blow you out of the water type of earnings report. It was a good, solid earnings report by Google, but nothing that meant we should raise our projections in any way, in any material way, at least. But there's still incredible value here, even at a 30% margin of safety. It's at $175.88 price. I still believe that Google is vastly undervalued. I believe the DOJ case will never rise to the level of forcing Google to divest search. But with all the other components of their business, YouTube, Google Cloud, even subs and platforms, and then once Waymo really starts to take off, there's incredible upside here.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.